All right, office fans, let's practice some of the exempt organization concepts and problems that appeared in our textbook. I didn't think I would be able to relate exempt organizations to the office, but it turns out I can. In 1999, Michael Scott promised to pay the college tuition of an entire third grade class if they stayed in school and they graduated. And if you're a fan of the show, you know that in 2009, 10 years later, he defaulted on this agreement. Michael Scott's finances, or the lack of organization therein, were a recurring theme in the office. So he was unable to pay the tuition for these students. But what if instead he organized a 501c3 organization called Scott's Tots, Inc. to raise and administer these scholarship funds? We're going to pretend like Scott's Tots grew so that he could sponsor one class every school year in perpetuity. Let's look at those tax consequences if you did. So let's assume that for his effort in managing the charity, Michael Scott draws a salary of $75,000. This, if you know anything about the office, is high. His salary for a year as regional manager of the Scranton branch of Dunder Mifflin is around 80 grand. It's also high because the executive director for an average charity of Scott's Tots size in the Scranton Wilkes-Barre area earns around $35,000 a year. This means that Michael Scott is earning an excess benefit of 40 grand. We compute the penalty by multiplying the excess benefit times the tax rate imposed by the IRS to arrive at the first level tax owed. Now, there's a penalty to Michael Scott himself for drawing such a high salary, and there's also a penalty that is imposed on the management of Scott's Tots for letting Michael get away with such an action. We'll look at the consequences of both these transactions. In both cases, the excess benefit is 40 grand, the amount above what an average executive director in the area would be earning. For Michael Scott, the penalty is 25% of what the excess benefit is, which means he owes a tax of $10,000 for drawing an excess salary. The organization incurs a 10% penalty for its part in allowing this to happen. So their first level tax is $4,000. Now, if Michael had failed to pay the organization back before Michael Scott and the management paid their first level tax? This is problematic for Michael. His original penalty for drawing too big a salary was 25% of 40 grand, $10,000. The second level tax he would owe for not making the repayment of the excess benefit is 200% of that excess benefit. So now, on top of the 10 grand he already owes, he now owes 80 grand as penalty. And as we alluded, Michael Scott's financial situation was precarious at best. So this is not good news for Michael Scott. So now let's look at lobbying expenditures. An important cause for Michael's organization is better funding of higher education. The less it costs to send someone to college, the less his organization has to pay to send the tots to college. So let's say that in a given year, Scott's Tots lobbying expenditures were 30 grand. During that same year, their expenditures related to the purpose of their organization was 150 grand. We compute the tax based on the lobbying expense. Scott's Tots made lobbying expenditures of 30 grand. They're taxed at a rate of 5%, which means the organization itself owes $1,500. Now, if Scott's Pot's management was complicit in this action and there wasn't a legitimate business cause, they too could be penalized for making the lobbying expenditures at a rate of 5%, the same $1,500 that the organization owes. Now, Scott's Tots has a legitimate reason for lobbying before the Commonwealth of Pennsylvania government and the United States Congress. Higher education costs have increased over the last few years, and that all of society is better off when higher education costs are low. Because of this, Scott's Tots can make a 501h election, which means that a portion of their lobbying expenditures can be excluded from this 5% taxation. So let's compute what this would look like for Scott's Tots. First, we'd start by computing the amount of lobbying expenditures that are exempted from taxation. There's a handy chart in your textbook that shows this calculation. Scott's Tots is an organization with exempt expenditures below $500,000. So their non-taxable lobbying amount is 20% of $150,000 or 30 grand. In the second step, we'd compute the lobbying expenditure ceiling. This is equal to 150% of the non-taxable lobbying amount. This is the amount that, if an organization exceeds too many years in a row, can jeopardize the organization's not-for-profit status. Finally, we compute the tax on the lobbying expenditures. This means that 25% of what's left over after deducting the non-taxable amount is taxable. Now let's think about Scott's Tots. Their lobbying expenditures were 30 grand, so they're exempt from tax. But should their lobbying expenditures increase or their funding decrease, they may be subject to tax. So before we move on to the last two exercises in this chapter, I wanted to give you a brief review of what is unrelated business income and what is not. So an exempt organization incurs the unrelated business income tax when the organization is engaged in a trade or business, the trade or business is not substantially related to the exempt purpose of the organization, and the trade or business is regularly conducted by the organization. Any unrelated business income dollars are subject to a 21% tax, or whatever the current corporate tax rate may be. So let's practice some examples to look at the nuances between each of those items. In the first example, let's assume that professors from colleges in the Scranton-Wilkes-Barre area help to prepare Scott's Tots for their SAT, ACT, and for the advanced placement examinations. These courses are free to Scott's Tots, but they're open to students in the area for a fee. Is it a trade or business? Yes. Advanced placement course preparation and standardized testing preparation is a big business. As a frame of reference, I paid $1,600 for my GMAT prep course that I took when I was getting ready to go to graduate school. What about the frequency? If these courses are offered on a regular basis, then it counts as a trade or business. But what about the middle requirement? Is it unrelated? No. Scott's Tots are receiving the course material for free. The other people are just subsidizing the cost of offering those courses. It's related. So therefore, Scott's Tots doesn't have to report any of the income for UBI purposes. Let's look at some other nuances. What if the professors donate their time? If the professors were being paid, that might sway the IRS to believe that it's actually a taxable operation. But if the professors are donating their time to the cause, then it's not unrelated, which is a good thing. Now, what if Scott's Tots recorded videos of the sessions, packaged them, and sold them or licensed them? This is additional income being received beyond the purpose of the organization. In this case, the licensing fees would be subject to the UBIT. Another example, what if at the beginning of each school year, Scott's Tots decided to sell bundled school supplies? They're able to buy these supplies in bulk, package them, and sell them at a profit less than what it would cost in time, energy, and money for parents to go buy the school supplies themselves. These school supply bundles are provided to the Scott's Tots free of charge. Now, how would you treat the revenue that's earned from sales to the community? Would it be unrelated business income or related business income? It is unrelated because you can draw a line in the sand and distinguish which portion of the revenue came from Scott's Tots and which portion of the revenue came from the community at large. Now, what if the Scott's Tots students paid a nominal fee for the supplies? This would be related business income because it's related to the purpose of getting Scott's Tots through high school and into college. Now let's practice what that means with an example. We now know that the school supply bundles sell for $100 per student. In the fall semester drive, 500 students purchased supplies bundles, including 100 students in the Scott's Tots program. Let's compute the unrelated business income and then the tax on that income. Like I said, when you know who's buying what, you can delineate the cost between the community purchases and Scott's Tots. So let's look at that. If the bundles sell for $100 a piece, the organization earns 40 grand for the sale to the community and 10 grand from the sale to the kids in the classes, the Scott's Tots. We can deduct from that revenue the cost of goods sold, which we're assuming to be $40 per bundle, the advertising expense, which we're assuming to be $5 per bundle, and the administrative expense. So the time spent and the effort put into putting together these bundles. Our net unrelated business income for the community portion is then $20,000. But remember, the portion from Scott's Tots is related. So we don't have to worry about that in our computation of net UBI. This is similar to the example in your textbook where the pharmacy sales within the hospital itself are not unrelated business income, but the pharmacy sales to the general community are. So we can then begin computing our net UBI, our UBI, and our tax on that UBI. Our net UBI from the community portion of sales was 20 grand. 1,000 of that is exempted from taxation by law, which leaves us with unrelated business income of $19,000. Currently, unrelated business income is taxed at a 21% rate, the same as what a corporate organization would pay. So the tax on that income would be $39.90. We've now concluded the practice problems related to Chapter 23, and you should be able to do your homework. As always, if you need help or clarification, contact me via email, or if you see me online on Moodle, feel free to message me. Have fun and happy problem solving.